Good morning, people. Happy market open for those who celebrate, and let's dive right into it. Let's see what's happening in the world, stocks, business, everything. So basically, yesterday on Monday, stocks closed a little bit mixed as investors were, all jiggery from that apparent possibility of the shutdown. But as we know, let's keep the cool demeanor. It's always a little bit of a kabuki theater. The people on the hill have to keep us entertained in order to distract from all of the bigger problems, right? So, we avoided the shutdown for a little while, but hey, that's just what's happening, right? And it's going to be here again, right? This is just a narrow avoidance. It will be there in a couple of weeks, and there will be more. But yeah, so basically a little bit of a mixed bag, but let's look into the details. So utilities got hit hard yesterday, minus 4.5%. I mean, that's, a little bit crazy, right? So what's going on? Well, of course, in this type of market, like almost all of the things that are happening are somewhat connected to the interest rates, right? So basically, lots of the stocks connected to utilities, energy and similar. Those are usually stocks that has a certain amount of dividend yield, right? So they attract a specific group of investors. And those people are now saying, okay, this utility company, they are giving me like a 3-4% dividend yield. But if I buy treasuries, I can get 5. So maybe I should just, go over there. And of course, that's a little bit that short-sighted type of behavior, right? Where people are just, switching, oh, there is this exciting stock and then there is this exciting stock, right? And, if the interest rates fall again, they are not going to get such a great yield from them. And maybe the, companies like utilities will get back, right? And we will talk about this a little bit later in the video. But yeah, just, everyone is now, like all of these investors that are chasing yields are now a little bit jiggery, like, okay, is it this dividend stocks or is it the treasuries or something like that? And that's all that's causing this mayhem, right? So in the meantime, you kind of see, IT, communication services, technology companies, those attract the growth investor, right? And they are doing their thing over there. But the dividend investors are now in a situation that they weren't in for the past decade, basically, right? They were just, choosing some of the dividend stocks, but now it's for the first time that they can get some real yield from treasuries. And that's also what we see over here, right? So this is totally crazy in my mind. So the total drawdown for the extended duration treasury ETF is down now 58.3%. So that's this red line here, right? And it's a long drawdown, right? It's basically lasted kind of for the past 2 years. And now it's greater than during the market crash of 2007 and 2009. So, all of these treasuries got literally destroyed, right? And that's also connected to the next slide, right? Like there is this usually in the financial industry 60-40 portfolio where kind of like the prudent financial advisor just, puts the person 60% into stocks and 40% into bonds. And as people get a little bit closer to retirement, they just put more and more into bonds, right? Because bonds are seen as safe haven. Well, as we have seen over the past basically 2 years, it's not that safe, right? So, there is often like this perceived safety where things that are deemed safe are actually, there is that like a end tail risk, right? So basically, what you've seen since basically 2020, 21, 22, 23, like the Vanguard total bond market, it just got freaking destroyed. So, don't trust the perceived safety. Make sure that you understand, what you're buying, what you're in. So, I mean, in my mind, in my portfolio, stocks are always superior, but it just comes with that additional caveat, right? We need to put in the time, we need to put in the effort, but if we do so, we'll get the results, right? So, those people with like 60-40 portfolio, those are usually those people that in a sense, don't want to touch anything. Hey, let's just buy like a basket of stocks and a basket of bonds, and the portfolio is just like spread out over so many different assets, so many different companies, ETFs with fees on top of fees, and they think they are safe, but they are not, right? So be careful about that. And connected to this whole theater with the dividend stocks, yields, treasuries, basically, you can see this silent crash in dividend stocks, right? Dividend stocks are doing terribly this year. Look at, just past month, McDonald's, Coca-Cola, Procter & Gamble, Next Era Energy. Like all of those got destroyed, right? Not just this month, but this whole year, right? Because if the stock is, giving you those 3-4%, that's nice, but the treasuries are 5, right? So, all of those people just go and treasuries, let's buy them. Okay, cool. But, with dividend stocks, sometimes you also have to understand that, hey, two things actually. One thing is that those dividends can over time grow and grow and grow, right? So if you bought McDonald's maybe 10 years ago, actually the yield on your cost basis is much, much, much higher, right? For people that might have bought McDonald's 10 years ago, they might be getting maybe, 6, 7, 8%, maybe more on their original cost, right? So even much more than the treasuries now. And secondly, are those dividend stocks really, that safe when lots of those companies at the maybe beginning of the year, maybe last year, they were trading so rich? Like at some point, McDonald's basically, growing low single digit, was trading at P of 30. 30 price to earnings ratio for McDonald's. Similar probably something for Coca-Cola. Let me just quickly Google it. I mean, what's the current P ratio of Coca-Cola? At the moment, it's 22, and that means, if Coca-Cola was around 15% higher, so, there was like maybe 26, 27 P for Coke, just 6 months ago, right? So you are actually buying these companies for a higher PE than, for example, Meta is now. Meta's PE is 19. Like, what are those people thinking? Buying dividend stocks that are almost, not growing at all for such a high PE, like, how are they thinking that it's going to end, right? So now is the time to maybe still wait, but, there might be actually some great opportunities in the dividend stocks over the coming months. But, you just have to do opposite of what everyone else is doing, right? Because those people are just, were piling into dividend stocks a year ago at crazy P ratios and relatively low yields, and now they got caught. Simple as that. And one more topic. Oh my God! Like this is getting crazy and also crazy exciting, right? The type of market we are in at the moment is not there to support IPOs. Jesus, like the 4 of the recent IPOs, Arm, Kava, Oddity, Instacart. All of these are down. Arm 12% down, Kava 26%, Instacart 27%, Oddity 33%. So, just the usual playbook, right? After that little bit initial pop, and then just straight down, right? And that's usually what happens in IPO, even in a good market, right? And now, like, people are now super distracted with all of this, what's happening. They are not thinking about the IPOs, right? Especially when you really overprice them, right? So IPOs, really, usually if you're buying IPO, your exit liquidity. So if some of those companies, and like some of those companies are great, like Arm as a business, oh my God. And I also have relatively positive things to say about Oddity. That being said, you just have to be a little bit patient, and usually with IPOs, just wait those 6, 9, maybe 12 months after when the price somewhat stabilizes, do the proper research, and then possibly buy, right? But definitely not on the IPO day unless you really want to trade it, but it's a different animal, right? Here we are talking about investing. God damn it. And ultimately, like this whole market this year, I mean, on the surface, it looks great, right? S&P is up, Nasdaq is up, but why? Well, it's mostly because of these few companies, right? Apple up 37%, Microsoft 40, Google 52, Tesla 121, Meta 140, Nvidia 200. Jesus, those are crazy numbers. But it's these few companies, right? And those are huge companies, right? So it's a little bit like this flight to safety. So, everyone knows, hey, Apple, Microsoft, Google, huge companies, super safe, still growing quite fast, and everyone's just like, okay, this is obvious. Let's do this, right? We don't know what's gonna happen in 2024. The interest rate, the inflation is still there. Let's just play it safe. Apple, Microsoft, Google. That's nice. I see the reasoning. Obviously, it works for the time being, but the rest of the market is still in almost like a dire situation, I would say. Because really, if you just focus on those magnificent seven, so-called, Facebook, Apple, Amazon, Google, Microsoft, Nvidia, Tesla, that's their contribution to the performance of S&P 500. If you would exclude those other 493 stocks, the S&P is basically flat on the year, right? So this is still not so good. And that's also what makes this market both exciting, but also obviously dangerous, right? We really have to be prepared for different scenarios that might play out. Like, if you think that you got it figured out, if it's, hard landing, soft landing, no landing, hard takeoff, which is a little bit a camp I might be leaning towards, regardless, like, that's type of the market, hey, let's be nimble. Let's keep our long positions, we have that long-term time horizon, 3, 5, 10 years, good. But still, have some money on the sidelines, maybe put on some hedges if you are a little bit more experienced, that's good. But really, focus on those individual companies, because overall, even in those 493 stocks, there are some that are doing great. There are some that are doing terribly. There are some that are doing, so. So, it really, like, whatever's happening with the market overall, it always comes down to you and if you did your own research, right? So, really, some quality companies, for me, for example, big Palantir position, right, did also tremendous, and that's not even an S&P company, right? Those are companies still outside of the index. And, there are so many great companies in those 493 or even outside, right? So in whatever market, you can always find great opportunities, but it comes with a little bit of a work. So that's that. And, that's kind of what we see here, right? Nasdaq, S&P 500 doing reasonably well or great, but the Russell 2000, barely positive on the year. So yeah, this is a weird market, guys. But hey, that's what we have to live with. And yeah, if you have any questions, let me know in the comments. Just a quick summary on the morning, and talk to you soon.